Evening, everyone, and welcome to Hibiscus Petroleum's Q3 Financial Year 25 results briefing. Thank you for taking your time to join us this evening. As Kuala Lumpur prepares to host the Asian Summit, we have some meaningful updates to share with you also. I'm Li Ling, VP of Corporate Development. Joining me today are Dr. Kenneth Pereira, our Managing Director, Yip CY, CFO, Joyce Wasudo, Finance, Deepak Thakur, VP of Economics and Business Planning, Mohammad Farouk, Country Head Brunei, and from my team, Andrew Fernandez, Noor Zehan, and Adila Alias. Earlier today, alongside announcing our Q3 FY2025 results, we made some key announcements, including an interim dividend declaration, an independent evaluation of reserves and resources following the 20 years PM3 CAA extension, and the release of a corporate and business update detailing financial and operational performance. All announcements and these briefing slides are available. With that, let's get started. Over to you.
Thank you, Lily, and good afternoon, good evening to everyone, and thanks for joining us. So without further ado, I'll go straight to the numbers. I hope you had a chance to see some of the explanations that we included in the QR, but this is a summary of where we landed compared to last quarter. I think this quarter, what I will do is I'll go straight to PAT and then I'll go back to revenue and EBITDA. Because that's really why that's really one of the big items I should highlight at the forefront. So in the quarter, you will notice that we have reported a loss after tax of 116 million. That is solely caused by a one-off charge that we have taken in the UK for a change in the expiry date for the energy profits levy regime, and that came into place in the early part of March 2020. If you recall, in the previous quarter when we explained the results in the QR in Q2, the quarter ended December, we did highlight that, and it was also in our QR last quarter. We did guided that there would be likely a one-off charge of this manner, the amounts of which can only be finalized when the change became substantively and became law in the UK, and that was in early March, as I mentioned. Now that impact is 167 million RM. That is non-cash, obviously, is basically a deferred tax liability charge, an expense to the tax line, and that has sort of distorted what you saw in the after-tax results for the quarter from the Hibiscus. Now, if you take that out, in the far right column of the PAT box, you'll see that our normalized profit after tax for the quarter is about 51 million. I'll go into a little bit of details as to how these numbers were arrived at. But so just to note, this deferred tax charge that you recognize, non-cash, will also be reversed in the future years. I'll cover that in the next slide. But I'll go back to revenue for now. So revenue in the current quarter, also something we have guided and informed when we discussed last quarter's numbers. The key item was that there was no crude oil sale in the PM3 CAA asset during the quarter. I mean, it's timing. That offtake took place in the June quarter, so slipped to the June quarter. Not slipped, actually, it was planned, and we knew from day one that we would not have a crude oil offtake in the March quarter for PM3. Now that's the main reason why, one of the main reasons why revenue is lower. Of course, oil price was slightly lower as well, but the main reason was because there was no crude oil offtake in PM3 as planned and as guided earlier. The good news is Brunei, an asset we took that was acquired in October 2024, continues to provide good upsides to the group. Now, in the quarter ended this March, Brunei contributed to 23% to our total revenue recognized quarter. That's substantial. And also the first time actually that we recorded a full 3 months contribution from the Brunei asset. We completed our acquisition in the middle of October 2024. So last quarter you saw 2.5 months impact. This quarter, full 3 months. In the EBITDA, I think one of the key highlights on this page really is that despite what I've mentioned on the revenue front, you will see that our EBITDA margin is still higher. I mean, it's only 1.8%, you may say, but it is high if you think about the fact that the revenue was lower and the fact that oil price was low. So we have maintained a very healthy EBITDA margin, in fact, beating last quarter's margin. And that's despite the fact that we recognize higher realized forex losses during the quarter compared to Q2 FY2025. Third point under this EBITDA column. So I'll go back to EAT. Depreciation, you will notice that when you go through the numbers, depreciation at group level was higher by 17.5 million. And that's really because our production improved during the quarter. You'll notice that other than PM3 gas, almost every single asset have performed better or almost on par with Q2 compared to Q2. And the gas short, the drop in gas production or output in PM3 is because in Vietnam there was lower demand by the government, and that's also coincided with the break over Chinese New Year period. So that's also something. It's not because we produce less; it is because the demand was less. So all in all, production good quarter. Sales as expected, and but the main item, of course, we look at the surface level is obviously the loss after tax, and that's really the tax that I've just mentioned. Now, a key item that I want to highlight during the quarter, or at least the 9 months up to this financial year, is on the box on the far right. That's interesting because for the 9 months ended March compared to last year, same period, our operating cash flows, as you will see on page 6 of the QR, have increased tremendously by a massive 144% from 620 million to 1.5 billion. So that's really something. I mean, that proves that despite all this noise that you see in the P&Ls, lots of them non-cash, the important thing is we are generating very healthy cash flows. Okay. So the next page, I'll go to the next page now. This is a snapshot of how things will look like in this energy profits levy regime in the UK. I mentioned the numbers. If you go right to the middle of the box in the on this page, you'll see two items, two numbers highlighted are bold. One of them was recognized in Q2 December quarter. There was a 7.3 million that you would have noticed when we talk about this last quarter, and the 167 million that I've just mentioned. Now, what we recognize in the P&L in the form of a charge last quarter and this quarter, they have to be reversed. They need to be reversed during the period, during the EPL regime. And that is going to end in 2030, extended from 2028 to 2030 during the quarter. And the total of which the entire amount will be reversed. Based on our existing estimation, our latest estimation, we think that out of this amount, 70 million would be reversed in the coming FY in 26. And we are quite, I mean, it's an estimate, of course, but we are fairly confident that this number is more or less, the actual will not deviate from this very far because we know roughly how much we're going to produce next year already. But the other reversals will come in 27, another big one, 84 million. And of course, after that, remnants of it in 28, 29, and until we finish the EPL regime based on existing legislation when it finishes in March 2030. Okay, so we will start to recognize a gain from this reversal in Q4 actually, in the June quarter. So you will see that there will be a very good credit amount again in the UK segment in Q4 in June. The next page, this you would be familiar with this page actually, and to summarize, other than actually all our assets across the EBITDA margin, look at the red bar across all charts. They're all very comfortably above 50% in terms of EBITDA margin. So all assets are profitable. They can fluctuate quarter on quarter, but on average, very comfortably above 50%. Brunei is about 50 for the quarter. Last quarter was even higher. So we will expect this to continue going forward. Okay, so profitable in all assets. Next page is a summary of key balances in the balance sheet. Not very different from last quarter, but I think one thing to note really is that if you look at our net cash position, it has gone up against our unrestricted cash. Actually, it has gone up versus last quarter from 430 to 553 million. And right at the bottom of that table, you will notice that our unutilized facilities that we can tap on to fuel the growth, capex investment and all, of about 1.1 billion. So that's RM. So that's substantial. And that comes after we have closed the facility in Brunei. I think we'll do that later in more detail. There's a box on the right hand side. There is a acquisition of Brunei asset that we have undertaken in October 2024. But to again reiterate, we did that without any external funding, no additional debt, and no equity issuance. So that's really a summary of what we have done so far. Okay, so we are going to the next page, the next section will be covered by Joyce. To you.
Yeah, and the strong balance sheet that CY showed you just now is actually really a culmination of our year-on-year sales growth. We acquired our first producing asset in 2016, Anasoria asset. That's our financial year 2017. And through the years, if financial 2019 shows the acquisition of North Sabah, and then we did the third producing asset acquisition in January 2022. So that's financial year 2022. And then we did Brunei. Actually, that's for financial year 2025. So just based on 3 acquisitions plus all the programs that we executed to drive production, all that, you can see the year-to-year growth in sales. That actually translates to a 6-fold increase in sales growth within the short space of 7 years, over 7 years. And all that up to from 2017 up to 1st January 2025 translates to about 35 million barrels of oil equivalent sales and production. So going to financial year 2025, at the bottom here, you see that we are actually on track to meet our sales target of 9.1 million barrels of oil equivalent. That represents a 17% increase of the financial year 2024 actual sales of 7.85 million barrels of oil equivalent. The important point to note here is that for financial year 2025, it does not include the sales from Brunei, because we completed the Brunei acquisition on the 14th of October 2022. So from 1st July 2022 to 14th October 2022, that does not include Brunei sales. So you would expect that for financial year 2026, we would have the full year of Brunei sales. So we would expect to show even greater growth in sales for financial year 2026. With regards to first our dividends, as you know, we've been increasing our dividends year on year from financial year 2021. Financial year 2021 was our maiden dividend, and since then, dividends have been increasing year on year. And for financial year 2025, we gave a minimum dividend guidance early on to state that we would be declaring between 8 cents to 10 cents per share for financial year 2025, depending on oil price between $70 to $80. So for the 9 months, up to the 9 months, we've already met the minimum dividend threshold of 8 cents. And that's really based on a $76 average oil price for the 9 months. So assuming that oil price remains at present levels, we hope to declare an additional dividend for Q4 2025. And with regards to when you compare 2024 dividends, this time last year we declared 6 cent dividend, which is and so this year's 9 months dividend is a 2-cent increase from 6 cent. With regards to share buybacks, from December 2023 to May 2025, we've bought back about 135 million ringgit worth of shares because we believe our shares are significantly undervalued. That translates to almost 68 million shares, and that represents about 8.4% of our total issued share capital. And I just want to note that our dividends are actually a priority spend. If you look at our capital allocation framework, we actually prioritize our minimum dividends over and above our CapEx spend. So we remain committed to deliver to shareholders at least in terms of dividends. April this year was actually was a significant month for us because we had two catalysts for future growth that occurred in April. First was the 20-year extension that we secured for our PM3 CAA PSC. And that's the key enabler of a PM3 Master Hub Plan, which we will go through, which Deepak will go through in the next few slides. We extended the 20-year extension, brings us from 2027 to 2047, and that's under enhanced terms. And the point to note is that it's at zero consideration. The additional barrels of 26 million barrels, that's actually that's been evaluated and certified by an independent expert, RPS. That was we've issued the report this evening, and that represents a 20% growth in net 2P reserves and 2C resources. A key point to note here is that when we acquired the asset, which was PM3 CAA, largely PM3 CAA and Kinabalu, way back in January 2022, we paid $212 million for this. And at that time, the 2P reserves was 23.3 million barrels for PM3 CAA and 10.8 million barrels for Kinabalu. So that comes up to 34 million barrels. So we paid $212 million for 34 million barrels. In this instance, we are not paying any consideration for 26 million barrels, which includes 2P and 2C. So we find that's a significant catalyst for growth and a value driver. The second point to note is that in April this year, we signed a $100 million syndicated Islamic financing agreement with two Bruneian banks, which is Bank Islam Brunei, Darussalam, and Baiduri Bank. Brunei, both these banks are actually not privately owned, not largely privately owned. It's majority control. Both banks are majority controlled by the Ministry of Ministry of Finance, plus the royal family. So what it shows actually, it's a testament of their faith and also their desire to partner us for future growth in Brunei, and it signals our long-term commitment and growth objectives in Brunei. Last point that we want to highlight is that our CapEx programs for financial year 2025 and 2026 is fully funded. It's through current cash balances, operating cash flows, and existing debt facilities. And this is actually this is based on the existing oil price scenario, that it is fully funded.
Thank you. Thanks, Joyce. Thanks, CY. Before I hand it over to Farouk, let's spend some time on the PM3 CAA extension in detail. Let's start with the 20-year extension. As you know, this is the first time any PSC has been extended for 20 years. So it itself is a great achievement for all of us. As you know, we talked about the PM3 Hub Master Plan, which involved PM3 CAA or making PM3 CAA as an anchor asset. And then we have assets around PM3 CAA, which we are trying to produce and develop using the gas infrastructure, which we already have at the PM3 CAA. Everything is possible now because of this PM3 CAA extension of 20 years. If you look at the PKNB clustered PSC, which expires in 2048, now with PM3 CAA extension, which goes up to 2047, so more or less the similar time frame in terms of the PSC timeline. So we can safely say that PKNB cluster and PK and PM3 CAA, both assets would be produced, would be producing up to 2047, 2048, you know, the timeline. In terms of the overall production life of the assets for Hibiscus, you know, it helps to ensure that Hibiscus would be producing oil and gas up to for another 23, 24 years time frame up to 2047. Then we have PM327, which is the exploration license. In the event of the commercial discovery, as you know, our plan is to monetize PM327 PSC, which is primarily the gas assets. So all of the gas would also be monetized and produced via the PM3 CAA gas infrastructure. Okay, we have few numbers here, but let's break it down before the PM3 extension, and then we will talk about with PM3 CAA extension. We acquired our first asset in UK North Sea we completed this transaction in March 2016. So we are showing you the net 2P reserves as at 1st January 2017 of 25.7 million barrel of oil equivalent. This was our net reserves numbers. This is just with the Anasria cluster. Then in 2018, we acquired North Sabah. Then in 2022, we acquired the Repsol Malaysia entire upstream portfolio. And then what we also did is we converted the 2C resources from within the North Sabah and the Kinabalu and PM3 CAA, converted those 2C resources to 2P reserves. And so in the process, we added 82.1 million barrel of oil equivalent, and also from the Brunei asset acquisition. So our 2P reserves, after producing 35.5 million barrel of oil equivalent in last 8 years, so from January 2017 to 1st January 2025, we have produced 35.5 million barrel of oil equivalent. So this is the actual oil and gas, oil condensate and gas sales volume from FY 2017 to FY 2024. So these are the volumes we have sold over the last 7-8 years. So if you combine all of these volumes, you'll get roughly about 35 million barrel of oil equivalent, which we are showing in the reserves replacement ratio slide. So we have produced 35.5 million barrel of oil equivalent, total volumes of oil and condensate and gas. And then we have added roughly about 82.1 million barrel of 2P reserves. So based on this, the reserves replacement ratio, which is the ratio of the reserves added and the amount of oil and gas produced, this comes to 231%. Normally, the company wants to maintain their target would be, the industry target is roughly about 100%. So you can see Hibiscus has done significantly better in terms of the reserves replacement ratio. So we have achieved 231%. Now with the PM3 CAA extension, we have added 2P reserves, and we have also added 2C resources. So how much 2P reserves we have added? We have added 12.6 million barrel of oil equivalent. It's gas and oil, condensate and oil. And then we have added 2C resources of 13.4 million barrel of oil equivalent. If we add 12.6 to this reserves added number, our reserves replacement ratio would be, it would improve from 231% to 267%, which is staggering, significantly much better number, right? And then we have 2C resources from the future projects, which we are going to execute over the next 4 to 5 years. So from 2026 to roughly about 2030 or 2031, these are like time frame over which we are going to exploit and convert these 2C resources of 13.4 million barrel to 2P reserves. To just to illustrate the point which Joyce was saying, mentioning about the potential benefit of this 13.4 million barrel of 2C resources and 12.6 million barrel of 2P reserves. So when we acquired PM3 CAA and Kinabalu, these were the two key PSC from Repsol we acquired in 2022. At that point of time, the net 2P reserves from the PM3 CAA was 23.3 million barrel of oil equivalent, and the valuation done by RPS Energy was 142 million US dollars for this asset. And this was done at a point of time in June 2021. At that point of time, the Brent price was roughly about $58 to $60 per barrel, in that range. So roughly about $60 per barrel oil price, the valuation of the asset was $142 million. Now, with PM3CA extension, we have added close to 13 million barrel of oil equivalent of 2P reserves, and then 13 million barrel of 2C resources. So put together roughly about 26 million barrel of oil equivalent. So just to give you a sense that this extension of the PM3CA PM3CA PSC has significant impact on the valuation of the asset. So we talked about the incremental 2P reserves of roughly 12.6 million barrel of oil equivalent, and then 2C resources of 13.4. So together 2P and 2C resources combined is 26 million barrel of oil equivalent. Based on the valuation done by RPS Energy, we have seen it has significant the valuation impact to Hibiscus asset. And it also helps us to improve our reserves replacement ratio. Okay, so this slide is just to give you a sense of what we are going to do in next 4 to 5 years in the PM3 CAA. As you know, there are ample opportunities for the oil and gas in PM3 CAA. So we talked about close to 13 million barrel of oil equivalent of 2C resources. As you know, we have 35% working interest. Our net entitlement is roughly about 22%. So if our net 2C resources are 13 million barrel of oil equivalent, which means on a gross basis, it would be roughly about 13 times 5, which is 60 to 70 million barrel of oil equivalent, would be the gross 2C resources, oil and gas volume, which we are going to produce over the next 20 years. So these are some of the areas where we are going to target, and drill those infill wells in the PM3 CAA. And these are, and in addition to those area, we have some few exploration targets as well, which we will try to, test and make discovery in the future. So there are significant ways to improve, significant potential in terms of increasing the value of the asset. So we talked about the 2P reserves of close to incremental 2P reserves of 13 million barrel roughly, incremental 2C resources of close to 13 million barrel of oil equivalent, and then in addition to that, there are some exploration upside as well in the PM3 CAA, which we will try to pursue in future. And in addition, what we have also seen is that the PM3 CAA extension provides the required foundation for our PKNB cluster development in futures, and also in the event of the discovery in the PM3 to 7 PSC, which is close to the PM3 CAA, we are going to use the same gas infrastructure. So this is our last slide on the PM3 CAA. So just to get a sense of how valuable PM3 CAA asset has been in the past. Even in the last quarter, January to March, we produced roughly about 26 to 27,000 barrels of oil equivalent of net production to Hibiscus. And out of that, if you see the contribution from PM3 CAA is roughly about 40%. So 40% of the total oil and gas production for the Hibiscus Group was coming from PM3 CAA. Close to 10 to 11,000 barrels of oil equivalent production was from PM3 CAA. If you look at last 3 years, FY 2022 to FY 2024, the revenue contribution from PM3 CAA has been roughly about 32%. The PAT contribution, so the bottom line contribution has been close to half, close to 51%, staggering. And then EBITDA about 41%. And in terms of the cumulative total production, it's a 45% of our total production has come from the PM3 CAA. So significantly, the very, very important asset for us. And it's good that, that we got a 20-year extension for the PM3 CAA. Previously, we had shown you the expected IRR on our investments in the PM3 and Kinabalu, which was 96%, as compared to at the when we signed the SPA, we had envisaged the IRR of 46% based on all of the good work that the asset team has done over the last 3 years. Our IRR without the extension, without the PM3C extension, was looking at roughly about 96%. And then you can imagine that with 26 million barrel of the additional 2P and 2C resources coming from this PM3C extension, our eventual IRR would be even much stronger than 96%. And all of the analyst consensus target price, they didn't include the value of that value coming from the PM3C extension, because we very recently signed the agreement with both Petronas and Petroleum. Okay, now I will hand it over to Farouk to take us through a few slides on the Brunei.
Thank you, Deepak. Okay, for Brunei, we took over Total Energy stake in Block B MLJ in October 2024. So with that, we now have 37.5% stake in that block. We're currently producing gas and condensate from 3 offshore platforms, MLJ 1, 2, and 3. And then we send the gas and condi via pipeline to onshore processing plant, which we operate as well. Before the gas is sold to Brunei LNG under a GSA, gas sales agreement, and the condensate is sent to Syria Crude Oil Terminal to be sold off. We see good opportunities within the block. We're working on the block now to maximize the value, mainly through optimizing production and also cost rationalization. Outside the block, we also see good potential opportunities within Brunei, with 2C reserves at a very healthy level. So we have been working closely with the Brunei government and authorities to see to explore potential opportunities to get additional acreage in Brunei. Joyce mentioned just now about the syndicated Islamic financing that we secured with BIBD and Baiduri, 2 banks, majority owned by Brunei Royal establishments and also the Brunei government. So we see a strong mutual support between Brunei and Hibiscus. This will not only provide us with financial strength for future expansion and growth, but also demonstrates our commitment and our vision for long-term presence in the country.
Good evening, everyone, and I think thank you very much for making time this Friday evening to hear the summary of our results. If I can just take it back to the first slide again, just to reinforce a couple of points. So this is the first slide that CY spoke about earlier on. So I just want to reinforce a couple of points. The profit after tax metric is impacted mainly by a non-cash deferred tax liability charge. It was something that we have guided the market. We have guided the market on this matter for a couple of quarters now, and I think during the last quarter, the results presentation, we actually gave an idea what the size of this charge would be. Important to note it is non-cash. From the perspective of real cash tax being paid in the UK this year, I think CY just pointed out to me that we should mention that due to the CAPEX program that we have in the UK over the past year, we are actually not paying any tax in the UK for this financial year. And from a real cash point of view. So this is a non-cash charge that we have to take because of certain accounting rules that are related to the extension of the tenure for the deferred for the EPL, the Energy Profits Levy by the UK government. It was substantially enacted a month ago or so, and therefore we have to take it up in this quarter. And another important point, it will be reversed. The effect of this will be reversed starting from the next quarter and over the next 5 years. So this total amount will be reversed out of our P&L over the next every consecutive quarters all the way up to 2030 actually. Okay, so that's the important thing to note about this slide. And the other very key point is this: the most important thing from our perspective as a company is our operating cash flow generation capacity, and you can see the numbers there. For the 9 months for this year, we have generated nearly 1.5 billion, well, over 1.5 billion ringgit in terms of real cash generated. So in terms of cash flow generation, everything very strong and much better than the year before. Okay, moving on to slide number 7. This is just to show that our EBITDA margins are extremely healthy. In fact, this quarter, our EBITDA margins are better than the previous quarter. So I think here just to say that again, we can't control the oil price, but what we are doing is making sure our EBITDA margins are strong and maintaining our EBITDA margins. So I think very important point to note about the slide. On slide 8, we just want to point out a little bit, when you look at our net cash position improving, our unrestricted cash position improving also a lot. So again, demonstrating in real cash terms the strength of the company. Okay. Slide 9, I think we'll talk about it a little bit. The number at the bottom, firstly, just to demonstrate the continuous growth we've been showing in our production. We've been growing except for the year we had the COVID financial year 2020, but otherwise the company's just been growing its production. And we are on track to deliver what we have guided, 9.1 million barrels of oil equivalent for this financial year. And this 9.1 million barrels of oil does not take into account the fact that actually we closed the Brunei transaction only in mid-October. Our financial year starts on the 1st of July. So the period from 1st of July to the 13th of October, we did not include production from Brunei for that period. So that was a full something like 18 weeks of production from Brunei excluded from this number. So notwithstanding any major issues, production next year will be higher than 9.1 million barrels, coming from full take-up of the production from Brunei, plus the effect of all the projects we are undertaking right now, the capital projects. So we expect to see even further growth. So as we've always said, we can't manage oil price because that is a function of commodity markets. But what we do is manage our growth in production, and we manage our costs to make sure we are running positive cash flows. So the important point to note on this slide. I think slide 10, just to say that we committed to deliver in a $70 oil price environment. We committed to deliver at least an 8-cent dividend payment. And I think that's already now been declared after 9 months. So we hope that the strong generation of cash flows will allow our board to improve on this number and in fact exceed our guidance. We hope for that. But again, it'll be subject to board decisions later in the year. I think on slide 12, we spoke about the PM3 CAA 20-year extension. Just to reiterate the point made by Joyce earlier on. So PM3, when we bought this asset in 2021, 2022, we paid over $200 million for what was at that point in time 23.3 million barrels of oil equivalent 2P, proven and probable reserves. Okay, so we paid over 200 million barrels. And those 23.3 million barrels, it's a number that was in the circular that was issued at that time. That 23.3 million barrels, okay, were curtailed only because the PM3 license at that point in time expired in 2027. Now, through this renewal, we have added another nearly 13 million barrels of oil equivalent. So you can imagine if we paid 23.3 million, we paid to over $200 million for 23.3 million barrels. The additional 13 million 2P that has been added just through the extension of the license, the value of that actually. The value of that is, it would have been, if those barrels were included at the time we bought the asset, it would have been over $300 million type asset that we would have bought in 2022. So that's just to give you an idea of the value of the dollar value of this extension actually. And then again, there's also another 13 million barrels of 2C resources. Those resources will require some investment, but the 2P is something that we can just continue to produce. It's a very important point. And then immediately in Brunei, the Brunei transaction was followed up very soon after by support from the two local banks with a funding facility to ensure that we are funded to develop Brunei further. So this is something that we're looking forward to Brunei being another hub of growth for us actually. Don't want to say too much about slide 13. I think let's say one thing about slide 13. Slide 13, what has been done? We've got a 20-year extension. Why is this 20-year extension so important? The 20-year extension, first, it gives us additional 2P reserves and 2C resources. But more importantly, it also allows us, we are operators of the PM3 license. It also allows us to integrate all the positive impacts of having the PKNB cluster development. This is a license that goes up to 2048. It's also a gas development. We have 65% interest in it. You can see the net 2C resource number that we will be able to unlock by developing this field. And this field is going to use primarily the infrastructure of the PM3 PSC that we are already operating. So by doing this, the regulators in Malaysia, Petronas, by doing this, they're going to allow us a lot of synergy between PKNB and PM3 CAA, allowing lower unit development costs of PKNB. So this is what we're going to leverage on. This whole area becomes a hub that we are going to operate. So this is going to be another hub of growth. So Brunei we see as being a hub of growth, and the PM3 area is also another hub of growth. These are discovered resources in PM3 and in PM3 on PKNB, but also upside if PM327, there are some exploration prospects that we are looking at, and there could be some upside coming from that. But we'll talk about that in the future if there is something tangible that comes out of the exploration activities there. The next slide is slide 14. Don't really need to talk about it too much, but just to say, the 35.5 million barrels, you see that gray box almost on the middle left side there of the slide. That's what the company has produced, 35.5 million barrels from 2017 until now. We have produced 35.5 million. When we started with our first producing asset, we had 25.7 million barrels is what we acquired when we acquired Anasuria. We have added 82 in the process of our acquisitions. We've added 82 million barrels through acquisitions and organic development of our assets. And we've produced 35.5, giving us. So we've built the company. We've replaced our reserves. As you produce, you need to always ensure that you're replacing at least as fast as you're producing. We've been replacing at a faster rate than we have been producing. We're now at, normally companies try to have a reserves replacement ratio of 100%. For every 1 barrel you produce, you find or you buy another barrel. But what we've been doing is we've been doing it more than 2 times that rate, actually. So that gives you some idea of our future. Okay. Then I think we've spoken about most of the slides. Brunei, we think about Brunei on slide 17 as being an area, a growth hub. So one growth hub in East Malaysia and Borneo, I would say mostly Brunei, and the other growth hub in West Malaysia around the PM3 area, PKMB and the PM3 CAA, both of them going almost to 2050. So a lot of growth opportunities, as we showed in the map earlier on. I think finally, then I come to the key messages slide on slide 19. So I think if you look at all the operating metrics, all the operating metrics are very strong. Production is strong. Production slightly lower than last quarter, but that was because it was the Lunar New Year period in Vietnam. So there's less requirement for gas. So they took a little bit less gas. I think Vietnam shuts down for about 10 days. So they took less gas during that period. So that affected the overall production for the quarter. But in terms of EBITDA margins, in terms of production, uptime, availability of the assets to deliver the production, all of that was very, very strong. EBITDA margin also very strong. We have also been delivering value to you quarter on quarter in terms of the dividend guidance, and we are expecting that our growth in production over the next year will be also demonstrated. I think for us the most exciting thing for the quarter were the PM3 extension. When we bought the asset in 21-22 from Repsol, we were thinking that maybe we could get a 5-year extension from the government, and we believed we could get 5 years. We hoped we could get 10. We ended up getting 20, which has just been a big bonus for the whole company, actually. And as I said, the dollar value of those barrels that are being unlocked just by extending the tenure of the license on better terms as well, it is just it'll play out over the coming quarters and years, actually. And then of course Brunei for us, it's a place we've been looking at for a while. Since 2022, 2023, we were looking at Brunei. We're happy to now get our hands around the asset and slowly make our mark there, and build relationships with the financial community and the regulators. So I think generally, apart from this, I would call it a blip. The blip being this non-cash deferred tax liability charge. People who do not read the details may not understand it too much, but it is a non-cash charge from certain accounting rules that we have to apply. It will be unwound over the coming quarters and years until 2030. This entire number will be reversed out again. I mean, it's been put in and then it's going to be reversed out. Starts as a gain. As it gets reversed out, it'll be added back. So it's just a technical process that we have to go to respect the accounting rules. But the reality is, from a cash perspective, we are not paying any tax in the UK because of our capital expenditure there. So we're getting all of it offset against various allowances that are available. Anything you want to add there, CY?
No. In fact, the reversal will start.
Yeah. Oh, yeah. And the reversal will start in the very next quarter.
Yeah.
You'll start seeing substantial amounts being reversed from this DTL charge. So it's just it's a little bit of a blip that we have to endure for the next few days, I hope, and as the market understands this. So I think I think the focus for us has been a very good quarter from our perspective, from the operations, has good uptime, good production delivery. Oil price is oil price, it's what it is. The entire economy of the world is where it is. But on the flip side, not many companies in this type of economic condition can tell you that they've delivered 1.5 billion of operating cash flows. I think that's the key number. That number has allowed us to fulfill our dividend commitment, and hopefully we will be able to even over deliver on that. It just depends on what the board thinks in the coming quarters. Okay, with the outlook. So I think with that we just leave it for some questions. Thank you so much again for spending your Friday.
Thank you, Ken. I'll start off with Alvin question from Philip Capital. Hi Lily, can I check why the tax provisions will be right back progressively up to
EPL regime ends on 31st of March 2030. So there is a definitive end to this as opposed to most other tax regimes. So all the non-cash charges that we have taken so far would have to be fully unwound in the form of a gain to the tax line by that time. So I think what we have on this page is just to illustrate to everyone that this could be the estimated amount of quantums that would be reversed in the respective FY up to 2030 based on production. So it could change, of course, but as I said earlier, for 2026, we are fairly confident that the actual should not deviate that much, right? Because we can at least, it's just 1 year ahead. Okay, so that's the reason why it will be fully unwound by 2030.
So Tawi's question is looking at the increase in 2P and 2C resources are in PM3 of 25 million barrels, and based on the full yearly production of around 4 million barrels, it seems like it can only produce 3 to 6 years, and the extension is 20 years. Can management help me to understand this?
Yeah, I can start. So currently it's producing roughly about 10,000 barrels of oil equivalent per day. In the last quarter, that was the number. So on annual basis, it's roughly about 3.5 billion barrel, and then it's going to, there's going to be the natural decline in the production numbers. So we are not going to just produce for 3 to 6 years, probably let's say in the range of 10 to 15 years. But then we will have the PKNB coming on, and then it would also help us to reduce the unit operating cost. So if by reducing the unit operating cost will also help us to improve or extend the economic life. So we believe fairly we would be able to produce the 2P reserves and 2 resources for next 10 to 15 years.
So just to say, so what we have done is when they look at the 12 to 15 barrels, the 12 million barrels 2P and the 12 million barrels 2C, basically the reserves auditors are looking at things that they can see now. There were other, you will see, for example, the blue blob over there, the bunga yarrow, you can see the bunga alacasia, which are blue in this chart. These are, if it's red or green, it's oil field or gas field. And then there are potential developments here, okay? These are going to be based on further studies and work. These are not yet built into these numbers, actually. So, and also the 2C number that you see, because it's a contingent resource and it's not yet been sanctioned, what happens is the reserves auditor generally would heavily risk it, actually. Deepak, can you help me and tell me roughly when it's 2C, how much they risk it by?
In the range of 25 to 50%, Ken.
Yeah, so and so basically it's 25% they kind of take up, I believe, right? Or 25 to 50% they take up. So they risk the numbers down, Tawai, by about half. Okay, so a lot of risking goes on the 2C because these are projects that have not yet been sanctioned by the board. Okay, so that is one element. So the 2C numbers could probably be double what they are. And then the Bunga Yarrow and the Bunga Ala Kosia, that requires, that's even been risked even more actually. So because they are only potential developments. So the reserves auditor is always going to be conservative. So that's why you end up with your calculations ends up with about 5-6 years of production. That's not how we see it. Okay, and again, when we start producing bungas, the PKNB opportunities, we will also be using the same infrastructure. So just like I said, it's going to be a growth hub for us.
Thanks, Ken. Thanks, Deepak. Thanks.
Thanks, Tawai. Yeah, I think Eng Xiaoying has a question. So the predicted capex in 2026 is $150 million, which is much lower than 2025. Will this impact production output in future?
Not in the immediate period. Again, Deepak, you can help me, but what we are expecting is to see production increase from the capex we are spending this year. We are expecting to see production increase. We are also expecting to see production increase from the fact that we will be taking a full year of Brunei production, and we are also doing some well intervention work in Brunei as we speak. We are actually doing well intervention work. So we are expecting to see all the impact of all of that impact production positively. Deepak, anything to?
Yeah. No, I think it's very clear, Ken. All of those projects, for example, Teal West and SF30 Waterflood Phase 2, where we are spending most of the money on, and in Brunei as well. So all of those help us to have the better production in the future, higher production in the future.
Tawai from FIM. How's the progress of Teal West and North Sabah project? Are they on track?
Yeah, so again, I will start it, and maybe Deepak, you can help me a little. So let's take one of them at a time. Let's talk about North Sabah. So North Sabah, there were two elements. The first element was the wells had to be drilled. We had to drill some oil-producing wells, and we had to drill some water injection wells. All the drilling program has been completed, and there has been an increase in the oil production from North Sabah from the wells that have been drilled. Now, there's another element to it. It is a water injection project. It requires water to be injected. So now we are waiting the delivery of what we call the water injection facility. This has been contracted out to a third-party contractor. It is an OPEX-based facility. In other words, we don't pay for it until it is delivered. And as soon as it gets delivered, it starts allowing us to inject water through the water injection wells that we have drilled. And then we should see over a period of time, as the water gets injected and repressurizes the reservoir, we should see an increase in production. So the part that we are supposed to have done, the delivery of the wells, that's been done. Very close to budget. I think very slightly more than the budget, but very, very small, marginally more than what we expected. But it's been done to budget. Now we are waiting the delivery of the water injection facility. Regarding Teal West, I think we have made a comment in the CBU that there is a delay in the delivery of the rig. The rig was originally supposed to arrive in mid-June. That has been delayed because of a problem on a well with a different operator on a different project prior to us. So they are still on a well that is prior to us in the drilling schedule with a different operator. And because of that, we expect first oil to be early in the new year as opposed to late November, December. It was supposed to be sometime around November, mid-November time. probably now going to be pushed to the right, maybe in January, maybe late February, maybe February. So that's what we are expecting. We are looking at how, how obviously we can try to accelerate that, but at the same time, also taking into account the risk of doing a lot of work in the winter time. So we got to try and, if you in the North Sea, you want to be doing minimal work in the winter time. So we're looking at all of those considerations. But overall, Teal West is, again, so far, as of yesterday, we had a project meeting. We are still on budget. Okay. A slight delay, but still on budget. Okay.
Xiao Ying is asking, can I know the range for the all-in production cost?
So I think the most relevant is the bottom row, average net OPEX per BOE.
Yeah, I think you should take out the
Block
block
46.
46 findings because that is very small. So you should ignore that. I think it's safe to say, okay, now actually if you look at it, Undersea cluster is also small compared to the overall group production at this stage. That contributes to barely 10 to 15% of our production. So if you take that out also to a large extent, then you are left with PM3, that's our biggest. Then of course you have North Sabah. And so in that range, you're talking about maybe about 17%, maybe that would be the right range between maybe 16 to 18. Maybe that should be what you're looking at.
But see, this is just for this quarter, right? I mean, for example, next 2 quarters, there would be higher OPEX numbers. And so on annual basis, it would be slightly higher than what we are showing here.
Yeah.
Especially for North Sabah. And,
maybe about 30%, I would say, if you go to this quarter for the full year average, possibly about 30% higher. So that would mean that it is closer to about 20 to 20, 24, 25, maybe.
In the meantime, Lokman from New Paradigm has asked, will there be any scheduled maintenance, especially for Brunei?
Let me start with Brunei. For Brunei, yes, this year we will have our major shutdown, major full-field shutdown, which happens normally every 4 years. So yes, there will be quite a bit of maintenance work going on now, and all have been incorporated in the budget.
Roughly around, I think the timing, it will not be in this financial year, I believe, Farouk, is next month.
Yes, it will be in September, yes. September 2025.
Raymond from CGSI is asking, is Hibiscus still evaluating the Ungu well for potential write-off?
Yeah, so here's where we are with Ungu. Ungu has, we've got some data back, and the question is, the question that's come to, and of course there is a petroleum system. It's kind of, yes, there is something you can do there, but what we are looking at is if and when we will do something there. I think now what is going to decide whether we write it off or not is what we do next with. Okay, so that is something we will be discussing internally and discussing with our board, and we will put a result. We will decide by the next quarter, by the final quarter results. The question is, what do we do with Ungu? Given all the capex, looking at all the opportunities we have, is it realistic that we will do a development in that area anytime soon? I think that is the question we have to answer. Do we want to park it in our carrying cost, or do we want to write it off because we don't have any immediate plans for it? That's where we stand at the moment. There is a petroleum system in place. The regulator has looked at all the results together with us and has signed off on that. So yes, there is something there that we could chase. The question is, in our priority list now, where is it? And so if we want to put it in our carrying cost, then we should have a plan for it and a timing for it. And looking at our capex, our priorities, we feel that it may not be something, it could be something that we may not pursue in the near term. I think that's where we stand at the moment. But we will need to discuss this with our board, whether the auditors will accept it as a view, because at the end of the day, it is something the regulators have signed off as being a potential prospect. I think that's so it's whether we think it's going to be high on our list. If it's not, then we may not want it on our books. So we'll just make a call on it in the next few weeks.
Okay, Dr. Ken, so you're saying that the well is viable, there are viable reserves to be developed, but it's just a question of whether the duration that you need to develop it is going to be very lengthy.
No, it's resources. It'll require appraisal. It'll require further appraisal. We've only got one well there, so it'll require appraisal first, then more development plan, etc., etc. So whether this is going to be done in the next 3 to 5 years, I'm not sure. Given all the other stuff we have, that's where we are. Okay.
How about Marigold? Is there any update there, or the GMAD?
Yeah. So Marigold, we are in the midst of testing the market to see interest for another party to come in. We are in a place where we are pretty comfortable with our development approach. We have got, I think, 3 or 4 parties that have expressed interest to look at the data. So we are just testing the market. As you know, Marigold, we have a large equity exposure. So what we are looking at is to see whether there would be a co-investor with us on something like this.
Okay, so you won't develop it unless you find a farming partner, right?
Yeah, that's exactly the position at the moment, because it's quite a big thing on us. Or unless the UK changes its fiscal regime fast, then maybe we might look at it a bit more with more equity kind of in mind.
Okay.
What we are seeing, Raymond, is that there are several countries, several companies in the North Sea, which are specifically North Sea centric. Actually, I mean, they live or die by the North Sea. Their production in the North Sea. North Sea is core to them, and they have not. Again, it's an issue of reserves replacement ratio. There's not been much reserves replacement in the North Sea, so they are looking at this at, like, how do they get 50 million or 30 million barrels on their books? Because some of these companies, one of these companies that's looking at it is producing 25 million barrels of oil equivalent a year. They produce 25 million. It's hard to find 25 million. So they're looking to see whether they can take this on to kind of give them a 25 million barrel replacement, things like that. So there are companies which are focused. I mean, 90 to 100% of the business is North Sea centric. So these are the companies that we have been testing with, and there seems to be interest. They're looking at the data now.
Yeah, talking about the UK fiscal regime, the EPL, the deferred tax provisions that you put in is in relation to Anasuria and Til West only, right? It doesn't include any GMAT related EPL?
So it's based on, but so predominantly it's Anasuria cluster, but there's a certain level, there's a certain amount for Til West because it is based on the carrying value asset the point when it became a law. That was in early March. So we did have a carrying value on GMAT, so we do have an element of the DTL on GMAT as well. But the big proportion of it would be Anasuria.
Okay, thanks.
So actually for the capex, the oil production cost, right? Actually, I come out with is like OPEX, and then plus capex plus the tax. It's like, let's say I get around 56 per barrel. I mean like 56 USD per barrel. Is it like within the range for this figure? The oil production cost.
I think you should not include the capex, but if you talk about managing the asset, then perhaps you want to add in the decom portion, right? Because that's something that you need to make good at the end of the life of each of the respective assets. But because if you to add capex, those capex typically will increase your reserves as and when they are incurred. So that will increase also your production. So there's a correlation, but based on existing profile and existing operating costs, I think what would be the right thing to do, or more appropriate thing to do, is to take your cost of production, which is what you saw on the table, that line. And we have said that for an annual basis, you probably want to increase it, inflate it by about 30%-ish, and then you can add in decom as well. So if you add in the decom, I think it's going to range above 30 to mid-30s.
Sorry, 30 to?
To about mid-30s. So I think a safe range, I think across the board, would be about closer to mid-30 range.
I see. Can I know like the tax plus royalty per barrel?
Tax. So the tax rate is different in each of the in each asset. In Malaysia, it is 38%. In UK, obviously the headline tax rate is 78%. But obviously, just now you mentioned, I think Ken also mentioned, for example, in FY2025, we are not paying a single cent of tax in the UK, despite all the charges, because they're all cash, because of the fact that we are investing into TOS and also into Anasura cluster. So there's UK 78%. In Brunei is 55% headline tax rate. So on average, again, because UK is a smaller component of our group numbers, you would see a tax rate of closer to maybe 45 in that range. If you average everything out between 45 to maybe 50. That's what you were trying to find out, is it?
Yeah. So for your oil production, your prediction is 30 to mid-30, right?
Yeah, including decom.
Okay, can. And then can I know, right, for Kinabalu, because the production is kept declining, does the company plan to shut it down or like?
No.
Okay. So actually, there won't be any well will be shut down in the near future, right? To be confirmed.
No field is going to be shut down. I mean, wells we shut in and it's on and off now and then, but no fields are going to be shut down. No.
But I just want to ask about the impact of tariffs. Is there any impact to you in terms of the equipment that you use and things like that?
No, Raymond. On the tariff side, no, apart from the fact that it hit the oil price.
Right.
No, but in terms of equipment, no, I don't think so.
Okay, I mean your operations in UK, I'm not sure whether you nothing at all, right? Okay. Sure. Okay, thanks. Good night.
Good night.
I just want to thank everyone again for joining today's briefing, especially since it's a Friday evening also. If you have any more questions, feel free to reach out to us. Just want to end on a light note also, since Lady Gaga's concert is happening in Singapore. So there are no poker faces here, just transparent numbers and real updates. Have a great weekend, everyone. Thank you.